Of course, checking your super balance over the last couple of weeks has required quite a steely resolve. There's also been a lot of focus on the government's proposed super changes and what will be the impact of unrealised gains. Now, we had a viewer write in and ask us to speak to Liam Shorte from SONAS Wealth. He joins us now. Liam, what do we do amidst this uncertainty, and particularly in the wake of these proposed super changes as well?
Yeah, that viewer was asking about what happens if that Division 296 tax comes in, where you're taxed on unrealised gains over 3 million. What happens if you've got a volatile asset and you actually have a loss? Do you get money back from the government? But what actually happens is those losses can be only carried forward. So, for somebody who has an asset that goes up 1 year significantly, under that Division 296, they could be taxed on that unrealised gain. And then if it suddenly has a drop the next year, you don't get tax back. You only get to carry forward those losses to future years. So this is one of the things that we hated about this Division 296 and that we're fighting really strongly against. I'm really hoping that if the next government, whoever it is, but the Liberals have said they won't go near this Division 296. The Labour still have it in their Treasury forecasts that they're still going to put it through. So I'm just hoping if they come back, that they're going to come back with with some changes to it, especially around the unrealised capital gains being taxed and also the indexing of that $3 million limit. So for the moment, it's relax.
Yeah, okay, so that's what I was going to say. So the question from our viewer was talking about the big drawdown that we're seeing in markets, what should happen if there are no changes made to this legislation. Would there be a lot of self-funded retirees rushing to withdraw funds prior to the election? So what you're saying is, hold tight, don't do anything.
Hold tight. Yeah, don't do anything at the moment. Superannuation is always going to be a very effective place to have a store of money. This is just an additional tax on the amount over 3 million. So it's just like what we're saying to people is get the advice on what your options are for the future, but please don't jump in and move things into another entity where it could be stuck in, because once it's out of super, if you're over 2 million, you're not going to be able to put money back in after the 1st of July. So, it's one of those cases where you please don't jump in and just assume that this tax is going to come, because I have a feeling it may just disappear into the ether.
And he asked as well about if you are withdrawing funds, does it matter whether you do it at the beginning or the end of the financial year?
No, so I did go through this and I did reply to that gentleman separately because it is a complex area. But just to give a brief here, there is nothing in the rules for this Division 296 tax that shows any benefit really of taking funds out earlier in the year or later in the year. It's really just worked around the balance at the start of the year, adding back withdrawals, taking away contributions, and looking at the balance at the end of the year. So there's nothing about timing. The only possible benefit of taking money out earlier in the year would be that you basically your balance will be lower. But the problem is you're taking money out of a tax-free investment early in the year, instead of later in the year when you could have had the whole year in tax-free phase before you take it out and still have the balance lower at the 30th of June next year.
Well, thank you, Liam, for answering a question from our viewer. I'm very pleased that our viewers see value in this information that we bring to them each and every day. Although I will say, he might want to give you a call and become a client. So there you go. You're welcome, Liam. Just while we're on this election, I was reading one of your notes saying, look, if you're looking for a bit of a side hustle, the election might prove the perfect opportunity. I'm at the phase where I just get asked to volunteer at school bake sales and stuff like that. But when I was a teenager, I actually worked at an election booth, made a bit of extra cash. So could that be something that retirees do?
Yep. So there's 3 strategies that you can use. So for a retiree who's on a part pension, they've got what's called a work bonus. So they're allowed to earn up to $300 a fortnight without losing any of their pension at all. So, and if you don't use it in one fortnight, you can bank it for the future. So somebody could, for example, work on something like the elections are coming up, and just go to the electoral roll site and you'll see that they're offering jobs, and you could earn up to 11,800 without affecting your pension at all. So that would pay for an overseas holiday. It'll be pretty good. So that's one of the strategies. And then for anybody who's over 60 and still working, one of the strategies, something like working on the electoral roll, or maybe invigilating at exams, supervising at exams. if you do a part-time job like that for a while, and you may need to take some of your annual leave or long service leave, or I've had self-employed people do it as well. You just do that job for the 7 weeks, I think the electoral roll job is for. And once you stop it, you meet what's called a condition of release. And that allows you to move your whole superannuation balance from accumulation into tax-exempt pension phase. Now, if you can do that at 60 instead of 67, you've got 7 years of tax-free earnings on your super coming through, and you'd also get a refund of those beautiful franking credits all the retirees love. And the last strategy on that is if you're between 67 and 75 and you're selling a property or you're selling some of those shares that you've made really good gains on over the years, you could use that part-time job to do what they call the work test, which after 67, you have to do at least 40 hours in a 30-day period during the year. And that allows you then to put concessional contributions into super for a tax deduction. And the beauty of that is if somebody hasn't worked for 4 or 5 years, not only can they put the 30,000 limit for this year, they could use any of the unused contributions that they have from previous years, which would be up to about 150,000 for someone who was retired 5 years, and they can have that part of their capital gain taxed at about 15 to 30% instead of up at the 47% tax bracket. So it's just looking at those strategy ideas to make sure that you're making the most use of the system, because at the moment nobody has a clue where the investment markets are going.
Mm-hmm. Very true. Fun fact, I live in an area where there's quite a few actors, and at the council elections, when they were handing out the things,
really?
I was like, how do I know that person? Then you realise they're like, some bit part on a Netflix show. We need to get your thoughts too, Liam, on the cyber attack that hit the superannuation funds and how vigilant people need to be about two-factor authentication, passwords, etc.
Yeah, and look, one of the things that I'm seeing is that a lot of the targets now are educated people, like people who have their SMSFs, but also people who see themselves as really good at researching and looking at the investments. But the problem is these scammers, they're working on these scams every day, and often they've trialed them in England and run them for a couple of years, and then they've perfected their chat lines. So by the time they come to you, they've got all the answers. They've got the glossy brochures to make everything look as if it's perfect. So you just need to be very careful of all the scams that are out there. And believe me, some of them are very, very sophisticated. So you're not always going to spot them. So what we're trying to do is get people to take on a little bit of more responsibility, get some training, and the Esafety Commissioner has now produced a whole load of articles and a course for people on dealing with texts and SMSF and email scams. And it just takes you through tips and traps and what to look for. So it's on a site called Be Connected, and you'll see that it's part of the Esafety Commissioner's site. And we're just asking people, do something like that, because that will then give you the confidence to start using two-factor authentication on your banking and your superannuation accounts, and also to get you to the level where you will use secure passwords and have a system in place for developing those, rather than using your own your same password every time with just changing a number at the end of it or putting an exclamation mark. The scammers know all of those things. So you've got to get to the stage where you're confident about how to identify the scams, but also confident enough to put all these new requirements as far as security in place, and making sure you beef up your password security as well.